In our last video, we were talking about the estate tax, the death tax, the inheritance tax, that big 40% tax that happens after you pass away. The good news is that in Georgia, that really only applies to very few people because we don't have a state estate tax. We only have to worry about the federal estate tax, which is currently sitting at an exemption level of $30 million per couple. So as a couple, unless you have over $30 million, we're not going to have to worry about that. Income tax is a slightly different story. So when I meet with clients and we're going through their assets, their wealth, we look at the equity of their estate. And included in the equity of their estate is often 401ks, traditional IRAs, 403bs, qualified accounts. These are accounts that are pre-tax monies. So the way that qualified retirement accounts work is that while we are working, we are taking this money out pre-tax so that it doesn't count towards our income tax at the time. And we're putting it into one of these qualified accounts. But as we retire, we are now required to start taking RMDs. So we have a amount of money that we're required to take every month. By the way, I'm not a financial advisor. I'm going to put that disclaimer on there. Please talk to your financial advisor about all of these. That being said, once you start taking your RMDs out, guess what? Now that money is going to be taxed. So now it's going to count towards your income tax. As you pass away and your spouse inherits it, they have a lifetime to withdraw from that money, but it is going to count towards their income tax. So there's definitely a strategy here. Oftentimes with pretty traditional financial advisors, it's, take like a 4%, stay below a certain income tax bracket, and then act like you have no money, like my parents. I'm like, oh my gosh, just take more money. But that happens. We see that all the time. That is certainly one strategy for that. Other strategies may include that you live very strongly off of your 401ks and retirement accounts. And then as you don't spend it all, you move it into investment accounts, because after you both pass away, or if you're not married, after you pass away and this money goes to your children, now it gets a little bit hairier. So now they're going to inherit this money in the form of an inherited IRA. They're going to have 10 years to withdraw this money, and it is going to count towards their income tax. Now, before, financial advisors, thought that we had some flexibility with how and when within that 10 years that they withdraw the money. Now the IRS has come out saying that you have to be withdrawing that money all along. You can't wait till the very last minute, or you can't take it all right up front. I think, again, I'm not a financial advisor, disclaimer. So as you withdraw this money, it counts towards your income tax as the child, and you will probably still be working a lot of the time. So that could actually have a much bigger impact, because the whole point of a retirement account is that while you're working, you're at a higher tax bracket. When you're retired, you'll be at a lower tax bracket. So you'll actually save money in taxes because you'll be paying a little bit less. But your kids, on the other hand, as they inherit these inherited IRAs, they might be actively working, and so it might actually bump them to a higher tax bracket. So there is some strategy there. It is always a good idea to talk to your financial advisor about this, to see if there's a way to backdoor some of these accounts to Roths, to see if that makes sense, to pull more, strongly from these accounts. Or, what, your kids are still inheriting extra money. I call it found money. If they have to pay some taxes on it, oh well. So either way, it is important to note that even if you don't have to worry about the estate tax, you may still need to take a look at those retirement accounts and income tax consequences for those.